All right.
All
So
right.
today we're going to talk with Dave Bryce from Priority Lending. And before we started, recording here, he was kind of talking to me earlier about like how much he's learning about credit and how complicated it really is. So we're going to learn about building our credit. Dave Bryce.
Yeah. Good morning, everyone. So yes, credit. I just want to talk about some of the misconceptions with credit, some of the things that we can do with credit, and just how important it is for your prospective clients to, know what their scores are, know what they can do to get their scores up, know how their scores, impact the type of financing that they're going to get. So yeah, let's start this baby. So credit, food for thought. So we're going to talk about, I guess, scores, repair, history, do's and don'ts. There are three major credit bureaus. I think most of us know this. We have Experian, Equifax, and TransUnion. When we pull a credit report, we pull all three at the same time. It's called a tri-merge credit report. So a lot of us now can pull our credit scores on these banking or credit card apps on our phones and see what our credit scores are. I've never seen one that's not more or never seen one that's more than one bureau. So when you're getting that score, you're just getting one bureau. The other thing is that's a completely different score, different scoring model that's being used. So than a mortgage pull. So if a client says, well, my credit score is a 725, I may pull the credit report on the same day that they got that score and I get a 687. And that's because there's different scoring models used on mortgage pulls versus consumer pulls versus auto loan pulls and so on. Things are weighted differently. There's different, scoring methods that are used, even though it may be the same bureau. They could have an experience score that says 725. My experience score could say 687. And so when we do these tri-merge credit reports, we end up using the middle credit score of the three that we get. So if they have a 751, a 725, and a 701, we're going to use the 725 credit score. And that's what we call their loan score. That's what their pricing's based off of. That score is kind of what dictates what type of loan that they're going to get. Now, if there's two borrowers on the loan and one of them has a middle score of a 725 and the other one has, say, a 605, well, we use the lowest middle score of whoever is on the loan. So if we had a situation like that, that co-borrower, we'd probably want to figure out a way to take that co-borrower off the loan because we have to use the lowest score of whoever's on the loan. That's the score we go by. There's not like any kind of averaging that happens. We get that question like, well, do you take an average of the scores? Or doesn't it matter that my score is 800, even though, my spouse's score is a 605? Doesn't my 805 kind of like bounce it out? And it's like, no. They look at it kind of like the weakest link of whoever's on the loan. So something in the chat is that, was Terry had messaged Jason. Okay, next slide. How is your credit? This just kind of shows you some different scoring ranges. We have, and it goes a lot lower than this, but if the score is in between a 660 and a 675, that's not too bad. 680 is still probably like on the cusp of being, I'm going to say it's almost considered a little bit lower. Used to be, 680 wasn't too bad, but I would say, as far as credit tiering and how loans are looked at, it's not the best score. So you want to be above a 680 if you can. The 680 to 719 is better. 720 to 759 is pretty good. And then once you get up into that 760 plus range, you've kind of reached like a terminal velocity as far as how the score will impact your pricing and what type of loan you can get. You can get all the best of everything if you got a 760 plus. There are some investors that want to see even a higher score, like a 780 plus. They'll have a little pricing adjuster if it's below a 780, but in general, 760 plus will get you the best financing. Minimum credit scores. This is a good one. So you guys know FHA, VA, we can go as low as a 580 credit score. Conventional, you got to have at least a 620 credit score. And then to do a jumbo loan, meaning anything over a 977, 500 loan amount, it's considered a jumbo loan or non-conforming loan. You need to have a minimum of a 680 credit score. This slide here, before I get into this, does anybody have any questions yet on anything that I just talked about in these last couple of slides?
I did. Well, maybe you're going to talk about it, but I'm just wondering, can the typical person see all three scores together? Is there a way that we can access that?
The tip you're saying yes, there is a way to do that. There's something called myannualcreditreport.com.
Oh, okay. Yeah.
Yep. I don't know if you've heard of that, but that was a government mandated thing that came out probably somewhere around 10 years ago. And it allows people to pull their credit score, and it's free. You don't have to sign up for anything. There's no memberships or anything like that, but that's what I usually have people go to if they want to see all three of their scores. But even when they pull that score, it's going to be a little bit different than the score that I pull. I share the information with people when I pull it. We're not supposed to give people a copy of their credit report. But the my annual credit report, they can get the three different credit scores. It's just not going to be the mortgage credit scores. Credit scores are really frustrating to me because it's actually a pretty mysterious thing. There's a lot of conflicting information out there as to how people understand credit. And so it's kind of a frustrating thing to me. But it's the best gauge we have, I guess, to show that people pay debt back on time at this point, you know.
Do you find, like, let's say I use the annual credit report, even obviously we know that what's the one that everybody, the Credit Karma is going to be probably way off, but you find with that one, is that typically higher or lower or any, than what you find, or is there any correlation?
I would say most of the time I'm seeing the Credit Karma score coming out higher than the mortgage credit score that I get.
And then what about annualcreditreport.com? How close is that typically?
That one I don't see as many people, it's not as, you can only do it once a year, and I just don't see as a lot of people pay for a service, it seems, with Credit Karma, and they're like really like watching it like every couple days they're seeing their score change a little. Yeah. So I don't know on the credit or the my annual credit report how much difference there is, but it will be different. It's they're not using the same scoring models. So yeah, like I was saying, if you went to buy a car today and they pulled your credit, I pulled your credit on the same day at the same time, and you went to get a Nordstrom credit card on the same day at the same time, all three of us will get different scores. And that's one of the frustrating things about credit is people are trying to pay attention and get their scores up. But it's kind of like this moving target because it depends which score you're talking about. In general, we all know that you pay debt back on time. You try to keep your utilization on the credit cards, below, I would say 50% usually. There's different tiers on that as far as how it impacts your score. But in general, just pay your debt back on time. You don't want to have too much open credit. You don't want to have too little open credit. And I would say a good happy medium is probably about 3 trade line credit accounts. But I'm going to keep going on this. And then, so Carrie, I don't know if that, I know we kind of got off on a tangent there, but there's a way.
Okay. Yeah.
Yeah. And like if your client, came to see me and I pulled their credit report, I would tell them what their 3 scores are. And I know they get, and Leah, you may be able to speak more on this, but they receive an email that tells them their credit scores, but I'm not sure if they see all 3 or if they just see their loan score, which is the mid score. But I think that they receive something that shows that their credit was pulled and what their score was. But I tell them anyways, just so they know, what we're looking at. And okay, here's something. So I think that there's this misconception where people just say, well, what's your interest rate? What rate do you guys offer on a 30-year fix? And it's like, well, that's a tough one. It's like, what's your credit score? What type of property are you purchasing? How much money are you putting down? What's the occupancy of the property? Are you buying this as an owner occupied, or is this an investment property or second home? The reason we made this slide is just to show you all the different adjusters there are depending on loan to value, credit score, property type, occupancy, type of loan. If there's subordinate financing behind that, meaning is there a second mortgage behind the first mortgage? Sometimes, we do 2 loans when we purchase a house. We'll do that because it'll allow us to go to a higher combined loan to value. Say somebody's got 10% down. We don't want to pay mortgage insurance. We can do an 80-10-10 loan where we do an 80% first mortgage, 10% second mortgage, and then the client puts 10% down. So that's what subordinate financing. And sometimes people have taken a HELOC out and we're just refinancing the first mortgage, and we have to subordinate that second, meaning we're asking for permission for them to temporarily lift the second mortgage so we can put a new first mortgage in front of it. And that will impact pricing, the fact that there is a second mortgage. So there's a lot to pricing. I don't want to get too much into the weeds on this, but just know that, they just need to, the client needs to, if they're asking you, well, what kind of rates do they have or whatever, what's your rate? Because people will call and it's like, well, that's not as easy as you would think. I can just tell you a rate, but really we should be pulling your credit, what type of property you're purchasing, et cetera. So, all right. What impacts your score? This is a little, what do you call these pie graphs, I guess, that give you an idea of what are the components of what makes up your score. So you got new credit accounts. If you have a bunch of new accounts that you've just opened, maybe you just purchased a car, maybe you got a couple of new credit cards, that will impact your credit score, especially if these new accounts are at their limit. Sometimes people will do these 0% bounce transfers of 14, 15 months with no interest. Sounds great. They give them a $10,000 limit as to how much they can transfer. They have a $15,000 long-standing good history credit card that they're paying, let's say, 12% interest on. And they're like, why would I do that? I'm just going to transfer that over and pay 0% with this new bounce transfer offer. But if you open up that bounce transfer account, you now have a brand new account that's maxed out. And that's how the scoring engines read it. And you get a real big ding on your credit scores when you do something like that. Even though you made no late payments, you did nothing wrong, really. You're saving yourself money. Did somebody say something? No. So anyways, new credit accounts can impact score. Types of credit you have. There's a variety of credit types like auto loans, credit cards, other credit accounts. They can affect your score. Your payment history, obviously, we know that. Don't make late payments. How much you owe. One of the biggest factors in credit scoring is what's your utilization of your credit accounts. What are your balances in relation to what the limits are? That's a big one. I've seen people that have no lates on their, I still remember this guy because it was the biggest head scratcher credit report I had seen, where he had no lates, never had a single late in his life. And he had about 10 to 12 credit accounts that had bounces on them. And some of them were maxed out. He was using using like all of his credit. His credit score was like a 620 something. And he had no lates on his credit report. So it's a big deal to keep your balances to, within I would say really you want to keep them below 50%, but there are different tiers that impact the score. There's kind of like lines in the sand. And it really depends. Credit is so complex. There's scoring cards that all of us have. I was telling Jason about that I've been learning about. Each bureau has 10 different types of scoring cards that each of us fall under. And I don't even know what scoring card that I'm on, but we're going to end up having different scores or scoring cards. Hold on a second. Somebody's outside my window here. Hang on just a sec. I'm in the middle of a Zoom here. I got to talk, Craig. Yeah. So anyways, we all have our own scoring cards, and it's very complicated. It's a mysterious thing, but they put us in different scoring cards depending on our credit history, lates that we've had in the past. Jason and I were joking, it's almost like a social credit scoring system, like, you know, they have in some of these other countries. I mean, it's kind of scary. But anyways, it's hard to quantify like how, you know, each of us could pay our accounts down to 30% of what the limit is on our we could all have different, it can impact our scores differently. It also depends on how long your history is, how many accounts that you have. There's a lot that goes into it. So it's hard to make just general black and white statements, you know, on credit. And then this last one, length of your credit history. Short history isn't a bad thing. If you show responsible credit management, having a few credit accounts is better than having no credit at all. Okay, this one baffled me the other day. There's some true or false questions that the answers to these actually end up being opposite of what most of us, I think, would understand to be true. So this first one says, I'll give this to Mr. Chris Fiamingo. If my borrower pays to have their rental information reported to the credit bureaus, it can impact the mortgage credit scores. True or false? So this page here, we'll go through these true or false questions, and then the next slide shows the answer to these. But what would you say on this first one, Chris? Are you there?
He's busy power walking, dude.
I would say yes.
Okay, who was that? I'll mark you down for that one. You would say yes?
It's Carrie.
Carrie, okay.
I would say yes too, except your intro to this whole section leads me to believe that it's a no.
Well, I just want you to tell me what you think, and then keep in mind that the answers to these for most of us are gonna probably be surprising, I think. And so these are some kind of misconceptions that are out there. You know, so many times I'll tell somebody to do something to improve their score, and then that person will tell me, well, this is not what I've heard. I've heard that if you do this, this is what's going to happen to my credit score. This hurts my score. This makes my score better. And I'm like, you know, so there's a lot of information out there. And that's one of the frustrating things about credit is they've made it so complex. There's so many layers to it. Anyways, okay, so we said I have Carrie down for yes on the first one. Don't worry. We won't mark you, you know, these are very surprising answers on these. So second one, let's ask this to Mr. Jason Fox. If my borrower applies for a mortgage with two different originators, 15 days apart, this will always count as a single mortgage inquiry.
I think not 15 days apart. No, I don't think so.
Okay. So you say false to that one?
I think, I don't know.
Yeah. All right. I shouldn't have given you guys
John says true.
What's that?
John says true.
John says true.
Mm-hmm.
Okay.
Hey, sorry, I missed my opportunity. I got distracted. True on that one for me too.
Okay. So next one is removing a medical collection account can cause the score to drop. I'm going to go with Terry on that one.
Sorry. What was which one was it?
So it's a true or false question. Removing a medical collection account can cause the score to drop.
False.
Okay.
I think it would make it stay the same.
What's that? Who's that?
I was going to say, I think that would make it stay the same.
Removing the collection account?
Yes.
Okay. All right. Next one. disputing a third-party external collection company account can help the score. I'm going to go with James. All right.
I'm gonna say true.
You say true?
I'll jump in. Yeah, true on that. Dispute the score. You get a rapid rescore. Right.
We'll see. All
Or
right.
the
Closed
Sorry. Yeah.
revolving accounts can still be factored into revolving utilization. Closed revolving accounts can still be factored into revolving utilization. This goes back to, the balance in relation to what the limit is. How much of that available limit are you using? I'm going to go with Rhonda on this one.
I think that's true too.
You're muted, Rhonda. All right.
She says false.
Sorry, I missed that one.
Okay. But closed revolving accounts can still be factored into revolving utilization. True or false?
Is that true? True.
Okay, let's see. I think you might be right on that one. Okay, I'm going to go to the next screen here. Here are the answers to these. If my borrower pays to have their rental information reported to the credit bureaus, it can impact the mortgage credit scores. False. It doesn't. It would impact your score on, say, like a Credit Karma credit score, but the mortgage credit score, it does not impact. Pretty wild, huh? You would think for a mortgage, you're reporting your rental information to the bureaus, it's going to impact my mortgage credit score. It does not. It does impact scores. It just depends on the scoring method that's being used and the type of credit pull that it is. I know. It's a head scratcher, but that statement is false. Okay. If my borrower applies for a mortgage with two different originators 15 days apart, this will always count as a single mortgage inquiry. False. So here's the deal on that. And I just listened to a credit gal talk about this that knows, she knows her stuff with credit. She works for the credit reporting company that we work with. So Experian has a 14-day shopping window. So if you had your credit report pulled 15 days, 15 days from, the last time you had it pulled, Experian would ding you on that credit pull. That would actually show up and count as another inquiry. Equifax and TransUnion have a 45-day window. So you have 45 days with Equifax and TransUnion, and it will count as a single mortgage inquiry. So that's another confusing thing. So really, as far as mortgages go, you really have 14 days because most all lenders are pulling a tri-merge credit report, which includes an Experian score, and Experian has the 14-day shopping window. The other two bureaus give you 45 days, but Experian is 14. So kind of confusing there, but really you have a 2-week window to pull your credit report, and you have that window to where it's not going to impact your score. Now it would not.
Wait, hold on. That defaults to the shortest window then, because it's
Correct.
a 3 full. Oh,
Yeah,
man. A lot
yes.
of other lenders I've heard in the past say 45.
45 for Equifax and TransUnion, 14 days for Experian. So apparently, as I was listening to this lady speak on it, all the bureaus used to be 14 days, and then Equifax and TransUnion eventually they made that window a lot more time, but Experian never changed it, and Experian's still at 14 days. So all right, the next one is, I know this stuff is a little bit of a head scratcher, but if you watch the presentation, this lady knows what she's talking about, and she'll explain it down and really get it granular with it and explain why. But the next one is removing a medical collection account can cause the score to drop. True. She didn't explain that one very well. I didn't get into the nitty-gritty with her on that one, but it can cause the score to drop by removing a collection. And I think that it has to do with, as weird as it sounds, if there's a longer standing history on that account, it can impact the score if you're taking an account off that is shortening your total credit history.
That's even you paid it off and it was in collection, and that doesn't help your score. Man, credit scores are whack.
Yes. And that's why, I've heard of, there's some class action lawsuits out there, some that they're trying to go after the bureaus on some of this stuff. But yes, there are some things. It's definitely not a perfect system. But yes, this would be removing a collection account, regardless of if it has a balance or not. Sometimes you can get these taken off if you negotiate with them or whatever. But yeah. The next one, disputing a third-party external collection company account can help the score. False. Just disputing it, that means it's still going to show on your report. It'll just show disputing underneath it. On the reports that we see, it'll say it's in dispute, but it does not help the score if you're disputing it. Okay. And I would say in general, and I think this lady said this too, in general, though, the one above that, the removing a collection account, that in general, that will help your score. So not to get it too twisted here, you want to remove collection accounts, but it can have an impact on the score. So it's kind of one of those trick question things that one, I don't love that question, because it makes it seem like, why would you try to remove collections then? I thought you're supposed to remove collections. Yes, remove collections, but it can cause a drop in the score. But I think that that's a very, niche type of situation where that would happen. The last one would be closing revolving accounts can still be factored into the revolving utilization. Yes, if you have 12 credit accounts that are maxed out and you just decide I'm going to call and close them all today, it's not like they're not going to look at the utilization and how much you've used those credit accounts. And obviously the reason you get hit on the utilization of these accounts is, statistically, if you're maxing out all of your credit accounts or a good portion of them, you're a higher risk. You look like you could be in financial hardship, like this person's, barely making it here. They're using every last ounce of credit that they have, type of thing. All right, I'm going to go to the next slide. Enough trick questions. This is really cool here. We do this I've done this on a lot of Joe and Jason's clients, even your clients, Chris. A lot of times you guys don't realize we're doing this, but we have a credit simulation tool where we can import this credit report into this into the simulation tool, and we can play with the balances. We can delete accounts. We can say if this account's closed. We can do all kinds of hypothetical tweaks to see how it impacts a credit score. The next slide we have shows a lady. Now, this isn't the best example because this lady, she had a ton of money to work with. She was selling a bunch of company stock that she had a window where she could sell stock. And she wanted to see what she could do to get her score up. For her, she had lots of high balances on credit accounts. You can see she paid $76,000 in this example and raised her score from a 710 to a 767. I've had people spend as little as $3,000 and raise their score from, say, like a 650 to a 750. And it was because this was a younger guy. He didn't have a long history, but the accounts that he had open, and he didn't have that many accounts, but the accounts that he had them maxed out, and they weren't very old accounts. And so, of his, the credit that he did have, it was all maxed out, and he didn't have, he just didn't have a long history. So when he paid his accounts down, which he didn't even have very big balances, it took about $3,000. We got to score up like 100 points, took him out of an FHA loan and into a conventional loan. He spent $3,000. Another thing that can be done is raising the limit. You make a phone call to the creditor and you say, hey, I'd like to see if I can raise my limit on my account. That's another way to lower your balance in relation to what the limit is without paying any money. So, but just know that we have this simulation tool and it's money. I mean, this thing will tell us exactly what the score is going to be. We'll have the person perform, the actions that we need to raise the score. They'll do it. We can get a score up in about 5 days. And like I said, sometimes we're raising a score like 100 points with very little money. But yes, one way to not use any money and help your score would be to, if you do have a balance on an account, you can raise the limit on that account and then you'll lower your balance, percentage. So, but yeah, know that we have that. And if you're working with another lender, you should ask if they can do something like this. I don't think the big banks really mess with this kind of stuff, but this is a really cool tool we have. And just know that if somebody says, well, my credit's not that great, we should really just take a look at it, because I'm going to say at least 9 times out of 10, I can get somebody's score higher with very little money than whatever I initially pull. I can look at it, put it into the simulation tool and get their score higher. So it's pretty cool. Anybody have any questions on this piece?
Do we have access to this tool?
What's that?
Do we have access to this tool?
You don't.
I would like to
No.
play with it.
Yeah, I think that there are tools out there. I think, doesn't like Credit Karma have something like this? I don't know. I don't know how accurate theirs is,
but yeah, who knows?
Yeah. No, this one actually costs a fee to use. So when we do rate, like this lady who we raised her score about 57 points. And yeah, again, I don't like this example because you don't normally have to pay that kind of money to raise a score. But this particular report we did. On this one, she probably ended up paying about $400 to raise her score. But I think on this one, it saved her over $5,000 in closing costs because we got her score up. And sometimes, like the client I was talking about, where the younger guy, where he raised his score about 100 points, this took him out of an FHA loan and into a conventional loan, which is huge because he was looking at condominiums, and condominiums, as you know, if you're doing an FHA loan, the condominium project has to be FHA approved, and that really limits the amount of, condos that he can purchase. So anyways, know we have that tool, and, we're always going to look and see if it's beneficial, if we can try to raise somebody's credit score. Sometimes raising their score 20, 30 points doesn't really do anything. But
Hey, David,
yeah.
can I ask a question?
Sure.
My mortgage recently got bought out,
Uh-huh.
and then I got dinged on my credit score because the mortgage company I was with prior got the balance decreased all of a sudden, and then I have a new mortgage basically.
Yeah.
So does that frequently happen with people? Like, especially
Yeah.
if
That's
somebody
another frustrating thing with credit, because you did nothing wrong. You had no control. But now the scoring models are reading it like you have a brand new credit account, basically. Well, it probably didn't show as maxed out. It probably showed what your original balance was. So you didn't get dinged for that so much as you just got dinged for having a brand spanking new account on your credit report. And there's nothing you can really do on that.
I'm sorry. I know we had a client that recently experienced that too. And now that I've experienced that, I kind of understand their frustration. But they were going to be searching for a mortgage, for their new home. And then, they ran into this.
Mm-hmm. I've had people that have had, perfect credit all their lives. They went on vacation. They had a late payment on a Macy's card. And it's because it just happened like within the last month, dropped their score like 60, 70 points. And they got hit hard on their pricing. Like, their closing costs ended up being over $10,000 more than what they would have been if they didn't have that little late on like a $35 payment on the Macy's card. Somebody else talking?
$13 billion valuation in this environment. That's key.
Who's that? What's the question? Maybe there's just some
Single
back.
pin needs to mute.
Okay. Okay. Next slide. Question, how long do credit pulls stay on your credit? 2 years. We don't see that when we pull a report. I only see the last 120 days, but apparently they're on your record for 2 years and probably have some sort of impact. Here's a good one on the right-hand side of this page. How long will negative items stay on your report? This is one too where there's a lot of misunderstanding or people just don't know. Late payments, that's going to stay on your credit for 7 years, 84 months. Judgment, 7 years. Short sales, up to 7 years on your report. A foreclosure, up to 7 years on your report. Chapter 13 bankruptcy, 7 years from the filing date. And then Chapter 7 bankruptcy, 10 years from the filing date. Then you have tax liens until lien is paid in full. Wow, plus 7 years. So you pay it and then 7 years. May remain indefinitely. I haven't seen that before where we had a super old tax lien on there, but it sounds like you don't want to have a tax lien. But that's how long this stuff sticks on there. And people will say, okay, well, what if I pay this account down to zero? Well, they'll have a late payment on that Macy's card. And they're like, screw these people. We're going to pay this down to zero. And we're closing this account up. We're never going to, we've been with them for this long, blah, blah, blah. How long is this going to be on our credit? 7 more years. Even though you paid it off and you closed it out, it doesn't make it disappear. It's still sitting on the credit report. This is a good one. Wait periods for a mortgage. So this shows you, the top here shows if you had a foreclosure, if you had a short sale, if you had a Chapter 7 bankruptcy, if you had a Chapter 13 bankruptcy. And then it shows you on the left-hand side, say that this was just a conventional plain Jane 30-year fixed mortgage through Fannie Mae or Freddie Mac. You can see that a foreclosure, you have to wait 7 years from when the title was transferred to the borrower's name. Freddie Mac, this says no waiting period requirement for loans receiving an approved eligible recommendation. So that's actually new to me. But that means that if we decision this through Freddie Mac, and this is saying LPA approval, that's Freddie Mac's automated decision engine is called Loan Prospector. And that's what that LP is. But it looks like it's possible to get a conventional loan through, even though you haven't had 7 years go by. It used to be both Fannie and Freddie wanted 7 years from a foreclosure. Short sale, 4 years. Again, Freddie Mac says, now here's the thing. Freddie Mac is saying no wait period, but I'm almost 100% certain that it's very, very hard to get this no waiting period requirement and get an approval. It says you need an approval. If that's on your credit report, it's like good luck getting an approval. I mean, if you had a foreclosure last month or something and you think you're just going to go get a loan again, I would bet good money that that's not going to happen. But that is what they say. They say no wait period if they receive an approval. Chapter 7. No, I should keep going down. FHA for foreclosure says 3 years. For a short sale, they say 3 years. It says exception, all mortgage payments on prior mortgage, as well as all installment payments were made in 12 months preceding the short sale, from date of transfer title to new case number assignment date. Case number, FHA uses case numbers for their loans. But in general, we're looking at 3 years from a foreclosure or short sale for an FHA loan. VA says 2 years. Same for for foreclosure and short sale. VA says 2 years. Okay. And then this bottom one kind of got cut off. It was a weird slide we had to put together. And but USDA says no wait period, but with, and it says GUS approval. GUS stands for Government Underwriting System. And I'm guessing most of, well, probably a majority of you guys haven't done a USDA loan, but USDA loans are great 0 down loans, but you gotta you got to buy in more rural areas. I don't want to get too much into USDA loans, but USDA loan is a zero down loan that can be done in more rural areas. No wait period, as long as you have a GUS approval for a short sale too. Now I'll go over to the bankruptcies, Chapter 7, Chapter 13. So Fannie Mae says 4 years for a Chapter 7, and they say 2 years for a bankruptcy, or for a Chapter 13 bankruptcy. And then Freddie Mac, again, they have this no wait period. This is new to me. I don't know why they say no wait period, because I know it's super, super hard. I guess they're leaving a glimmer of light for people that have had a bankruptcy or a short sale or foreclosure. Freddie Mac says if you receive an approval, that means through their automated, all of these loans that we do for people, first we have to run them through an automated decision run. Then they get underwritten by a real person. And this is all lenders. Any conventional loans that are done out there, they're run through either Fannie Mae's desktop underwriter, they call it GU, or Freddie Mac's loan prospector. So anyways, they say no wait period. FHA says 2 years from a Chapter 7. From a Chapter 13, they say you have to have a completed plan. There's no wait period if it's been at least 12 months, more than 12 months since discharge dismissal. If less than 12 months, documented satisfactory payout, plan in progress, 12 months of satisfactory payout with court approval. I've had one of these where we had to get court approval for them to get a loan. VA for Chapter 7, they say 2 years. And then looks like they have the same guideline for a Chapter 13. No wait period if it's been 12 months is a discharge or dismissal. And if it's less than 12 months, we need documented satisfactory payout for the last 12 months. So if anybody doesn't know, like Chapter 7 bankruptcy is more of a like wipe your slate clean type of bankruptcy, where Chapter 13 you're agreeing to make payments on the debt that you're defaulted on, and you're it's actually, I don't know how you'd say it, like a more honorable like way of doing a bankruptcy, because you are paying the people back on a Chapter 13. USDA no wait period with a GUS approval, government underwriting system approval. And then Chapter 13 bankruptcy, USDA, it's looks like it's very similar to what FHA and VA say. So anyways, I think that we all know that you can't just turn around and buy something after a foreclosure or bankruptcy. So this just gives you an idea of, okay, well, how long do the people have to wait? And it looks like never say never. If you're trying to do a Freddie Mac loan, it's possible that you can still do a loan right after having, a foreclosure, short sale, or bankruptcy with a Freddie Mac loan, which Freddie Mac, Fannie Mae, both of those are just a regular conventional loan. So it's just, you have basically two different agencies that make the rules for conventional conforming loans. Okay, next one. How do I move this here? Hey, Jason, can you tell me how I can move this top bar that shows all the, mute, stop video? Sorry, I just want to.
You should just be able to drag it.
Okay. Charge-offs, collections. Did you know paying off an old charge-off usually helps, but can hurt in small portion of cases. Charged off accounts can still be considered in revolving utilization. Some of this we covered with those true-false questions. Let's see, the truth about how the score treats collection company accounts such as medical collections. The score only cares that they exist and when and how recently they occurred. The score doesn't consider the balance field. So it doesn't matter if it's $50 or $5,000, it's still looked at the same. But here's a new thing that's going on right now. That's a pretty big change with credit. It says the credit bureaus are screening out paid medical collections. This is big. We see a lot of people that have medical collections on their credit report. Medical collections with a zero balance or medical collections that are less than $500 are now being screened out of credit reports. So we don't see those anymore. They're not going to show up on the report. We used to sometimes see 8 different, medical collections on there that were less than $500. Now those are gone. We won't even see it. So it's got to be a bigger medical collection if it's going to show up on the credit report. And then it says, if a medical collection is currently reported paying, settling the account, zero balance will automatically remove the collection. So that's actually, new too. And it kind of goes in line with that, because if you bring it down to a zero balance, that's what it says. Medical collections with a zero balance are being screened out of reports. So that's a big deal. All right. Let's see. Improving scores. What can we do to improve scores? Increase credit limits only takes 1 to 3 days. That's really just a phone call. You can, I've seen people do this many times by just calling the creditor and saying, I'd like to raise my limit on my account, and we get their score higher that way. You can pay credit cards down, of course, and lower the balance to limit ratio. So that's like that credit simulation tool that I was showing you guys. Oh, did somebody have something? No? Okay. Call the creditor and ask them to remove a late payment. Get the right person on the phone and see if you can get them to remove that. We've had people get that done. Sometimes it's really hard or near impossible, but it's always probably the best way to go about it is first, if you do have a late pay that you don't agree with, see if they'll remove it for you. Improve scores and buying power, debt to income. So consolidate revolving debts for a lower debt to income with an installment or loan refi. If somebody has a car payment, and let's say that their payment is $700 a month on their car. By the way, a $700 car payment equates to about $110,000 in house. So car payments can really cap somebody's buying power if they have big car payments. But say they have a $700 car payment and they have maybe a $12,000 balance on that car. They're going to pay it off in the next year and a half or something. Somebody like that, I would tell them to, if we needed more room in their debt to income ratios to qualify for a higher amount, I would tell them to pay that to within 10 payments of being paid off. And then we can exclude that out of their ratios. So if they owe $6,000 and the payment's $700 a month, our underwriter would exclude that from their debt to income ratios, even though they didn't pay it off and they still have that payment, because it will be paid off within 10 months, they'll exclude it from the ratios. Credit card, if it's a credit card, like a revolving, say you had a Nordstrom card, you need to pay that down to 0 to exclude that from the ratios. You can refinance debt into someone else's name. I think that the thought behind that one is we've had people that have car payments refinance, have a sibling or a family member just refinance the vehicle into their name. We've done that a few times. So, or they could obviously sell the vehicle. But there's a lot of creative things that can be done to lower debt to income ratios. So I would say more than 9 times out of 10, we can do something to increase the ratios. Whether it be, shifting debt from one name to another, paying something down, bunch of stuff. Obviously, wait for derogatory credit to fall off. Yes, derogatory credit will impact your debt to income buying power. My ratios can go higher if I have a higher credit score. So there's a lot of factors that it'll look at, but many times we'll be allowed to go up to a 50% debt to income ratio. That means that the mortgage payment plus any other payments show up on the credit report. They'll allow that to go up to 50% of the gross monthly income of the borrower or borrowers. So if most of the time, I'm going to say we're capped at about 43 or 45% of the gross monthly income. But when somebody has really good credit and they have some good compensating factors, like they have a lot of reserves after closing, meaning they have a lot of assets, liquid assets, and maybe they're putting a little bit bigger down payment down, and they have really good credit. A lot of times they'll allow us to go up to 50% debt to income ratio. So credit definitely can impact how high. There's not just like a line in the sand as to what the debt to income ratio can be. Sorry. Okay. Avoid while in process. So this is just saying, don't get your credit pulled during the process if you can help it. Don't go buy a bunch of stuff on credit. I tell the story a lot of times. I've had somebody be in the contract to buy a house. They went to Ethan Allen to buy furniture for the house. Hold on a second, I'm gonna take a sip of water. They went to Ethan Allen to buy furniture for their house, put it on credit. They were getting a 20% discount by opening up an Ethan Allen account. We did a soft pull right before closing and saw that they had like $20,000 in new debt on their credit report. They put all this furniture, just were going to deck out their house in Ethan Allen furniture, and they had a big payment on that. And they disqualified themselves for the house that they were buying the furniture for. So believe it or not, people do this more often than you would think. And they don't ask or they don't tell anybody and they just go do stuff. I've had people buy cars in the middle of transactions. They're really looking, they want to make sure right before closing. Again, they do this soft pull about 10 days before closing, just to make sure that somebody didn't go out and buy a new house in the middle of buying this house, or they just want to make sure that they're qualifying with the correct amount of monthly payments and that somebody didn't go do something. And so anyways, definitely taking out new debts can hurt, and if somebody does want to do something in the middle of the transaction, that's okay, but they need to run it by, you or me or whoever, so we know what's going on. Missed payments, obviously, don't miss any payments. And then it says, if you increase your current revolving debts, that could also change your monthly payments, change your debt to income ratios. So you kind of just don't want to do too much in the middle of a transaction if you can help it. And that's it. That is pretty much what we got on this